It started quietly, after the markets closed, when most decision makers assumed Monday would open like any other trading day. But before New York woke up, before analysts updated their models, before risk desks adjusted their exposure, silver had already crossed a line that cannot be uncrossed. $84 was not a price level. It was a signal that the paper system blinked, that physical supply spoke louder than algorithms, and that institutions built on leverage were suddenly forced to react, not control. While Western markets debated resistance levels, another market was paying far more and draining metal at a pace no balance sheet had planned for. This was not volatility. This was not speculation. This was a structural failure unfolding in real time. And if silver can do this, the question serious operators must ask is not what moved, but what breaks next? Because once trust leaves a pricing mechanism, it never returns quietly. Welcome to Hidden Currency. If you value clear thinking over noise, if you believe markets should be understood, not chased, and if you have lived long enough to know that financial systems fail slowly, then suddenly, consider subscribing. Not for alerts, not for excitement, but so you do not have to rely on headlines written after the damage is done. And before we begin, tell us something important in the comments. From which country are you watching today? They did not expect it to happen this way. For years, the silver market had followed a familiar pattern. Prices moved within a managed range. Sudden spikes were quickly suppressed. Sharp rallies were faded. Each surge was met with paper selling strong enough to force prices back into line. This pattern created confidence, not among everyday participants, but among institutions that believed the system itself was stable. That belief ended the moment silver reached $84. This was not a slow climb driven by optimism or speculation. It was a sudden, forceful move that occurred in a narrow window of time. Silver did not rise, it jumped. And when it did, the behavior of the market revealed something more important than the price itself. It revealed a loss of control. To understand why this moment matters, they first had to understand how silver had been priced for decades. The global price of silver was not determined by the movement of physical metal. It was set by contracts, promises, and leverage. For every ounce of silver available in vaults, many more ounces existed only on screens. As long as confidence remained intact, the system worked. Most participants never asked for delivery. Positions were rolled, closed, or settled in cash. Physical metal rarely moved. Stability was maintained not by supply, but by belief. But belief is fragile. On the day silver jumped to $84, something beneath the surface shifted. The paper price in the West continued to signal control, while the physical market began signaling stress. This divergence had been growing quietly, but now it was visible. In parts of the world where buyers demanded real metal, silver was already priced much higher. This was not a normal price difference. It was a warning. If silver could be purchased cheaply in one region and sold at a premium in another, physical metal would move, vaults would empty, inventories would thin, and the paper promises tied to that metal would be exposed. The jump to $84 was the market reacting to this reality. From a technical perspective, the move was sharp and unusual. Silver opened lower, dipped briefly, and then surged almost vertically. Such moves do not happen because of excitement. They happen when buyers are forced into the market with no choice. Forced buyers are not speculators. They are institutions with obligations. Somewhere in the system, large positions were exposed. As prices rose and physical premiums widened, risk models failed. Margin requirements increased. Collateral ran out. At that point, decision-making ended and automation began. The system bought at any price available. This is how control is lost, not through emotion, but through structure. After reaching $84, the price pulled back slightly. Many observers called it a rejection. They assumed the rally had failed. But this view misunderstood the moment. The pullback was not strength from sellers. It was resistance from those trying to survive. Despite heavy selling, silver held above key levels. The market absorbed pressure instead of collapsing. This behavior signaled that something fundamental had changed. In earlier years, spikes could be reversed because supply was assumed to exist. This time, that assumption was breaking. Physical metal was moving away from public markets. Availability was no longer guaranteed. Silver at $84 was not an ending. It was a transition. It marked the shift from managed stability to forced adjustment. And once that shift begins, outcomes are no longer shaped by intention, but by necessity. They believed the damage could be contained. When silver jumped to $84, the first reaction inside financial institutions was not panic. It was calculation. Risk desks ran models. Analysts searched for explanations. Strategists looked for familiar tools that had worked in the past. The assumption was simple. This was another spike, and spikes could always be managed. That assumption was wrong. For decades, whenever silver prices moved too quickly, the response followed a script. Futures selling increased, margin requirements were adjusted, volatility was introduced to shake out weak hands. The objective was never to stop the price permanently, only to restore hesitation. Once confidence returned, the market would settle back into its range. This time, those tools failed. The reason lies in the difference between price management and supply management. The paper market is excellent at influencing price. It is powerless when physical supply is unavailable. At the center of the paper system sits the COMEX. On paper, it represents one of the largest silver markets in the world. In reality, the amount of deliverable metal backing those contracts is small relative to the volume traded. This imbalance is not a secret. It is tolerated because delivery is rare. The system assumes that most participants do not want silver. They want exposure, they want liquidity, they want price movement without storage, shipping, or custody. That assumption held until physical buyers began to act differently. As silver prices diverged between regions, large consumers stopped behaving like traders. They behaved like operators securing inputs. In Asia, pricing on the Shanghai Gold Exchange reflected immediate physical demand. Metal was not being rolled forward. It was being removed. This created a problem no algorithm could solve. If paper selling pushed prices down in New York, it did not create new silver. It simply made Western prices cheaper relative to Eastern prices. That discount accelerated physical outflows. Every attempt to suppress price increased the incentive to drain inventory. This is the paradox that broke the system. In prior cycles, suppression reduced demand. In this cycle, suppression redirected demand geographically. The more aggressively paper prices were pushed down, the faster metal moved out of reach. Institutions began to understand this too late. Volatility, once a weapon, became a signal. Sharp intraday swings no longer scared physical buyers. Instead, they confirmed urgency. Buyers who feared supply disruption viewed price drops as temporary opportunities, not warnings. This shift changed behavior across the entire market. Funds that had previously traded silver tactically began reassessing exposure strategically. Industrial users stopped relying on spot markets and started negotiating direct supply agreements. Refiners prioritized long-term contracts over exchange sales. The visible inventory began to shrink, not because production collapsed overnight, but because distribution changed. This is how systems fail quietly before they fail loudly. The paper market continued operating. Contracts still traded, prices still printed. But the connection between those prices and real-world availability weakened each day. The market looked functional while becoming hollow. From the outside, this appeared confusing. Headlines showed prices pulling back after the initial jump. Commentators declared the rally unstable. Yet beneath those headlines, the flow of metal told a different story. When a pricing mechanism loses credibility, participants stop trusting its signals. They stop waiting for confirmation. They act preemptively. This behavior creates feedback loops that models are not designed to capture. Risk models assume liquidity. They assume two-sided markets. They assume that sellers exist at every level. Physical shortages break these assumptions. At that point, control does not disappear all at once. It erodes. Each intervention requires more force than the last. Each price smash produces a smaller effect. Each recovery happens faster. This pattern is known but rarely acknowledged in real time. It marks the transition from management to reaction. For entrepreneurs and business leaders, this moment matters because it illustrates a broader principle. Systems built on abstraction fail when they collide with physical constraints. No amount of leverage can replace missing inputs. No financial engineering can manufacture atoms. Silver exposed this reality because it sits at the intersection of finance and industry. It is both asset and material. When industrial demand asserts itself, financial dominance weakens. By the time silver reached $84, the question was no longer whether the system could restore control. The question was whether it could adapt quickly enough to avoid a disorderly adjustment. History suggests such adaptations are rare. In the next part, the focus will shift away from exchanges and toward boardrooms, where the real decisions were being made. It will examine why industrial buyers became the decisive force in the market, and why their behavior placed a firm floor under prices that paper mechanisms could no longer break. They were not watching charts. Now, while traders debated price levels and commentators argued over technical patterns, a different group was making decisions with far greater consequences. These were procurement officers, supply managers, and executives responsible for keeping factories running. Their concern was not price volatility. Their concern was interruption. For them, silver was not a trade. It was a requirement. Modern industry depends on silver in ways that are difficult to replace. It is essential for electronics, energy systems, batteries, and advanced manufacturing. Its properties are unique. Conductivity, reliability, and efficiency cannot be replicated at scale with alternatives. When supply becomes uncertain, industry does not wait for clarity. It moves to secure material. This is where the market truly changed. As silver prices jumped and regional spreads widened, industrial buyers stopped trusting exchange prices as indicators of availability. Instead, they began acting on a more basic question. Will the metal be there when it is needed? For companies operating at global scale, a shortage of silver does not mean higher costs. It means halted production, missed deliveries, broken contracts, loss of market share. These outcomes carry consequences far greater than price increases. Executives understood this immediately. In Asia, physical pricing on the Shanghai Gold Exchange reflected urgency. Metal was being purchased for delivery, not for storage or speculation. This sent a signal to industrial users worldwide. If silver was being pulled east, it would not be available elsewhere. This triggered a shift in behavior. Instead of buying through exchanges, companies began pursuing direct sourcing. They contacted refiners. They negotiated with miners. They explored long-term agreements outside public markets. This material never appeared in inventory reports. It never touched exchange vaults. It moved directly from production to consumption. This phenomenon is often described as off-market supply, but the term understates its importance. What was happening was a reallocation of silver away from financial circulation and into industrial control. Consider the position of a company like Samsung SDI. Its investment in advanced battery technology depends on consistent access to critical materials. Production lines cannot pause without significant cost. When supply uncertainty increases, procurement decisions become defensive. The same logic applies to manufacturers such as Tesla. In high-volume production, even minor delays compound rapidly. A missing component can idle an entire facility. In that context, paying more for guaranteed supply is not a cost, it is insurance. This explains why higher prices did not reduce demand. Traditional economic models assume that rising prices suppress consumption. That assumption holds for discretionary goods. It does not hold for essential inputs. When a material is critical and irreplaceable, demand becomes inelastic. Buyers accept higher prices to avoid operational failure. Silver entered this category. As prices moved higher, industrial demand did not retreat. In some cases, it accelerated. Buyers who feared future shortages acted sooner rather than later. This created a reinforcing loop. Higher prices signaled scarcity. Scarcity triggered faster purchasing. Faster purchasing reduced visible supply. This is how floors are formed in markets, not by policy, but by necessity. Meanwhile, financial participants struggled to interpret what they were seeing. Price dips were treated as reversals. Rallies were dismissed as speculative. But industrial buyers were not responding to narratives. They were responding to logistics. From their perspective, exchange volatility was noise. What mattered was access. This divergence created a silent transfer of influence. Control over pricing shifted away from leveraged paper markets and toward entities that required physical delivery. Once this shift occurs, it is difficult to reverse. The reason is simple. Financial actors can exit positions. Industrial actors cannot exit operations. This asymmetry changes market dynamics permanently. When financial pressure attempts to push prices lower, industrial buyers step in. When prices rise, they continue buying because availability matters more than cost. This behavior stabilizes demand at higher levels. For business leaders observing from outside the metals sector, this moment offers a broader lesson. Markets are often assumed to be governed by finance. In reality, they are governed by function. When a resource becomes strategically necessary, its value is determined by use, not opinion. Silver crossed that threshold quietly. By the time the price reached $84, industry had already begun adjusting. The visible market lagged behind the real one. The screen price told one story. The flow of metal told another. This is why attempts to restore control through volatility failed. Volatility affects traders. It does not deter factories. As industrial demand anchored the market, the role of financial suppression diminished. Each downward move encountered immediate buying. Each recovery occurred faster. The range narrowed upward. The market was no longer searching for balance. It was discovering a new reference point. In the next part, the analysis will examine the broader implications of this shift, why silver AS behavior signaled stress beyond one market, and what it revealed about currency credibility, capital allocation, and the limits of financial abstraction in a resource-constrained world. By the time silver stabilized above $80, the market had already delivered its message. The price was not the message. The mechanism failure was. What unfolded was not simply a metals rally. It was a warning about how modern financial systems behave when abstraction collides with reality. Silver became the messenger because it sits at a rare intersection. It is traded like a financial asset, yet required like an industrial input. When pressure builds in both roles at once, there is no easy release valve. This is why the response from institutions felt delayed. Financial systems are designed to manage expectations, not shortages. They function best when assets can be created, substituted, or delayed. Currency can be printed. Credit can be extended. Contracts can be rolled. But physical materials obey different rules. They must be mined, refined, transported, and delivered. These processes cannot be accelerated by policy decisions. Silver exposed this limitation. As the price jumped, attention initially focused on banks and traders. But the deeper issue was not leverage. It was credibility. A price only matters if it can be trusted to represent access. When buyers no longer believe that screen prices guarantee delivery, the price loses authority. This loss of authority spreads quietly. Once one market demonstrates a disconnect between price and availability, participants begin questioning other markets built on similar assumptions. They ask whether contracts truly represent goods, whether reserves truly exist, whether promises can be honored under stress. These questions are not dramatic, they are practical. For business leaders, credibility is not philosophical, it is operational. A supplier that cannot deliver on time forces contingency planning. A market that cannot guarantee access forces diversification. Capital moves away from efficiency and toward resilience. Silver's behavior signaled that this shift had begun. The widening gap between paper price and physical cost revealed a deeper issue within currency systems. If silver appeared expensive, it was not because silver had changed. It was because purchasing power had weakened. The price movement reflected stress within the unit used to measure value. In that sense, silver was not rising, it was adjusting. This distinction matters. When assets rise because of enthusiasm, they fall when sentiment changes. When assets rise because the measuring system degrades, the movement tends to persist. Confidence does not return easily once questioned. For decades, stability was maintained through trust. Trust that contracts would settle. Trust that markets were deep. Trust that intervention would restore order. These beliefs reduced the need for physical verification. Silver forced verification. Industrial buyers did not wait for reassurance. They acted. Their actions created a floor beneath the market. This floor was not psychological. It was functional. Below certain prices, supply simply disappeared from public view. It moved into private hands, where access mattered more than transparency. This dynamic changes how markets behave going forward. Volatility remains, but its role changes. Instead of reversing trends, it accelerates repositioning. Instead of discouraging participation, it forces decisions. Those waiting for clarity often find it removed. For young entrepreneurs and aspiring business leaders, the lesson extends beyond commodities. Systems optimized for speed and leverage are vulnerable to physical limits. When those limits are reached, advantages shift to those who control inputs, logistics, and relationships, not paper claims. This applies to energy, materials, data infrastructure, and even labor. Silver's jump to $84 did not end a cycle. It exposed one. The system did not collapse, but it revealed where strain concentrates first. Markets tied to physical reality reprice before abstract markets do. Those watching closely understood that silver was not an outlier. It was an early indicator. As trust erodes incrementally, adjustments occur unevenly. Some sectors respond quickly. Others lag. This creates opportunities and risks that cannot be modeled easily. Strategy becomes more important than prediction. The banks involved in silver did not lose control because they made errors. They lost control because the environment changed. Tools designed for liquidity could not resolve scarcity. Once that became clear, outcomes were no longer negotiable. This is the final takeaway. Markets do not announce structural shifts clearly. They hint, they diverge, they misbehave. Only in hindsight do patterns appear obvious. Silver's move was one such hint, subtle in cause, dramatic in effect. For those responsible for capital, operations, or long-term planning, ignoring such signals is costly. The purpose of analysis is not to forecast prices, but to recognize transitions. Silver marked one. Whether others follow depends not on sentiment, but on supply, trust, and the limits of abstraction. And those limits, once tested, rarely retreat quietly.